Welcome to another deep dive. Today, we're diving into the fascinating realm of the psychology of money, drawing insights from the book of the same name.
Hmm.
You're here because you're keen to grasp complex topics quickly and thoroughly, and that's precisely our aim, to unpack the crucial and often surprising ways our minds influence our financial lives.
Right. And this isn't really about stock tips or, complex investment strategies, is
No,
it?
exactly. It's something even more fundamental.
What's compelling about this exploration, I think, is that it steers clear of those complex financial models. Instead, it uses relatable short stories, historical events,
Yeah, observations of everyday human behavior.
precisely, to illuminate our relationship with finance. It's less about spreadsheets and uh, more about understanding ourselves.
Exactly. Our mission today is to really get to the heart of why financial success so often hinges on those soft skills, our behaviors and thought patterns, rather than just pure technical knowledge or, intellectual horsepower.
Okay.
Okay, let's start by looking at a striking contrast presented early in the book.
Yeah, we're introduced to this compelling paradox,
Mhm.
the financially brilliant versus the consistently ordinary.
Right.
The book tells the story of a technology executive, undeniably a genius in their field, who amassed considerable wealth, only to see it evaporate due to, emotionally driven financial decisions.
Right, a familiar narrative almost. Someone exceptional in one area being completely undone by the psychological pitfalls of money.
Yeah,
And then we have the contrasting case of Ronald Reed. Now, this is where it takes an unexpected turn.
right.
Ronald Reed was a janitor and a gas station attendant, not exactly the profile of a financial titan you'd think.
Indeed. Yet, without any formal financial training, Ronald Reed accumulated a surprisingly substantial fortune
Oh.
through unwavering consistency and patience. He simply stayed the course over decades. The core insight here isn't about intelligence versus simplicity, but the power of emotional regulation and long-term thinking over short-term brilliance in finance.
So the natural question arises. How does a highly intelligent tech executive stumble while a seemingly ordinary janitor builds significant wealth?
Well, the book posits two potential explanations. The first, of course, is luck. Can't discount that.
Yeah.
But the primary focus is on the profound influence of the psychology of money, that these behavioral skills often outweigh sheer financial acumen.
It really makes you think. This prompts an important reflection on the financial landscape we see today, doesn't it?
It does. Over recent decades, the finance industry has attracted some of the most brilliant minds graduating from top universities. We've witnessed a proliferation of sophisticated financial instruments and intricate analytical techniques.
So much brain power going into it.
Exactly.
Yeah.
But has this influx of talent demonstrably improved outcomes for the average investor?
It makes you wonder, doesn't it? We've seen collective learning drive progress in so many fields. Trial and error has refined practices in agriculture, engineering, medicine. But has that same process truly made us less susceptible to debt, more prepared for our financial futures, or, more grounded in our expectations of what money can and can't provide for our well-being?
That's a critical point. And it leads us directly to the significant impact of personal experience in shaping our financial perspectives.
Ah, yeah.
The book convincingly argues that our individual histories and encounters with money exert a far greater influence on our beliefs than objective data or readily available information.
So, consider someone who lived through the hardship and uncertainty of the Great Depression.
Hmm.
Their fundamental relationship with money, risk, and financial security will be vastly different from someone who grew up during a period of sustained economic prosperity, right?
Absolutely. The book uses a particularly vivid example to illustrate this divide. Frederick Lewis Allen's observations on the enduring impact of the Great Depression stand in stark contrast to John F. Kennedy's strikingly different experience. Due to his family's considerable wealth, Kennedy openly acknowledged his lack of first-hand understanding of the Depression.
He even said his family had bigger houses, more servants during that time.
Yeah, exactly. It shows how different realities can be.
That really brings it into sharp focus, doesn't it? Someone as intelligent and informed as Kennedy simply couldn't truly grasp the deep-seated fear and insecurity that the Depression instilled in so many others.
And that profoundly shapes everything: beliefs about recessions, investment strategies, risk tolerance, even basic financial priorities.
Yeah.
Precisely. What might appear to be a completely illogical financial decision to one person can make perfect sense when viewed through the prism of their unique personal history and the narrative they've constructed around money.
The book offers a really thought-provoking example here. Individuals with limited incomes often purchase lottery tickets.
Right. On the surface, allocating scarce resources to something with such improbable odds seems, well, irrational. But if we try to understand their perspective, the book suggests it can be seen as an investment in hope.
Hope.
Yeah, a tangible possibility of a better future that otherwise feels unattainable. It's perhaps the only time they can realistically envision having the kinds of financial freedoms that wealthier individuals often take for granted.
That example of the lottery ticket highlights how context is everything. Okay, so our individual past significantly influences our financial views. Let's shift focus slightly.
Okay.
What about the wider financial landscape? How has that evolved, often more recently than we might realize?
Yeah, this brings us to what the book calls the illusion of entitlement, particularly concerning retirement.
Illusion of entitlement. How so?
Well, it challenges the assumption that widespread private pensions were a common feature before World War II. In reality, the norm for most Americans was to work until they were no longer able.
So the idea of a comfortable retirement funded by personal savings and
It's a
investments,
relatively recent development. It really only gained traction in the 1980s.
it's easy to assume previous generations had this whole retirement thing figured out, but
But the book points out that key retirement savings vehicles, like the 401k, only emerged in 1978.
wow, that late.
Yeah, and the Roth IRA even later, in 1998. As the book humorously notes, the Roth IRA wouldn't even be old enough to legally buy a drink in the U.S.
Ah, so this lack of a long history means many of us are essentially newbies navigating this landscape.
Exactly. We're navigating this without the benefit of generations of accumulated experience to draw upon when it comes to long-term saving and investing for retirement.
And it's not just retirement, is it? The book highlights similar significant shifts.
Right. Areas like college attendance and tuition costs, which have surged dramatically in recent decades,
And consumer debt.
and the widespread adoption of consumer debt mortgages, credit cards, auto loans, which really took off in the latter half of the 20th century. So in many ways, we're all learning in real time within these relatively new financial territories.
This relatively recent transformation underscores why relying solely on personal anecdotes or assuming long-established norms can be misleading.
We're all operating within a system that has undergone dramatic changes in a relatively short period. Absolutely.
Now, another crucial element the book explores in depth is the role of luck and risk, and how incredibly challenging it is to truly separate them from skill.
Oh, definitely. The book uses the compelling story of Bill Gates' extraordinary opportunity to attend Lakeside School in 1968.
Lakeside.
Yeah, which remarkably had a computer, a truly exceptional circumstance for a high school student at that time, maybe a 1 in a million chance.
So pure luck gave him a significant head start.
You could argue that. It
Yeah.
provided him with a significant advantage. And the book contrasts this with his equally skilled friend, Ken Evans, who faced less favorable circumstances.
And didn't achieve the same level of, global recognition.
Exactly. The key takeaway is the inherent humility we should have when judging financial success, recognizing that even the most skilled are subject to forces beyond their direct control.
It highlights the inherent difficulty in accurately assessing financial success, both our own and others.
For every highly visible success story, there might be an equally capable individual who simply encountered different, less advantageous circumstances or faced greater unmanageable risks.
It brings to mind economist Robert Shiller's insightful question.
Yeah.
How do we distinguish between a fundamentally flawed investment decision and a sound decision that simply had an unlucky outcome? It's often so difficult to discern in the moment.
Precisely. We have a natural inclination towards constructing simple narratives that attribute outcomes solely to individual skill or failure.
But the reality is often a much more intricate interplay of luck, skill, and risk tolerance.
Right. The book provides some fascinating examples that really blur these lines. Consider Cornelius Vanderbilt's famous, maybe infamous, quote.
What do I care about the law? Ain't I got the power?
That one. His immense success was partly attributable to that aggressive boldness, but it could have just as easily led to ruin. And Benjamin Graham's concentrated investment in Geico, which actually went against his own well-established principles of diversification.
Even Graham.
Even Graham. It illustrates how even the most disciplined investors can have their fortunes significantly influenced by what might be considered a lucky break.
And Mark Zuckerberg turning down Yahoo's billion-dollar offer.
Exactly. Was that visionary genius or a high-stakes gamble that happened to pay off? Hindsight gives us a clear narrative, but in the moment, much more ambiguous.
These examples really underscore how challenging it is to extract definitive lessons from financial history when luck and risk are so deeply intertwined and often invisible.
It serves as a crucial reminder to approach financial success, both our own and that of others, with a healthy dose of humility, and a recognition that factors beyond pure skill invariably play a significant role.
Okay, so we've explored personal experience, the evolving landscape, luck, and risk. Now let's delve into a concept that seems deceptively simple but holds profound importance: the idea of enough.
Ah, yes. This is beautifully captured in the anecdote involving Kurt Vonnegut and Joseph Heller at a lavish party hosted by a billionaire.
Oh, I love this story.
Right. Vonnegut playfully remarks that their host made more money in a single day than Heller earned from his iconic novel Catch-22 over its entire history.
And Heller's response.
Simply, yes, but I have something he will never have, enough.
Wow. That's such a resonant statement. It really forces you to consider what the ultimate objective is.
It does. And the book explores the inherent dangers of not having a clear sense of enough through the contrasting and cautionary tales of Rajat Gupta and Bernie Madoff.
Right. Both individuals achieved extraordinary levels of financial success and wealth.
Incredible levels.
Yet they ultimately risked and lost everything in their relentless pursuit of ever more.
What's particularly striking about their stories is the sheer magnitude of the wealth they already possessed. Their subsequent actions weren't driven by any fundamental need,
No, not at all.
but by a seemingly insatiable craving for further accumulation. It starkly illustrates the absence of a personal boundary defining enough. It's almost a universal human struggle, isn't it? That feeling of always wanting just a little bit more.
It's a powerful cautionary tale. Highlights how easily the pursuit of more can become detached from genuine needs or even rational desires.
And the book touches on how social comparisons significantly fuels this relentless drive. The perceived ceiling of what others possess is constantly being raised.
Like keeping up with the Joneses, but on a massive scale.
Exactly, making the quest for more a potentially endless and ultimately unfulfilling endeavor.
This connects directly to the somewhat counterintuitive advice from a Las Vegas casino dealer mentioned in the book.
Oh yeah, what's that?
The only way to win in a Las Vegas casino is to exit as soon as you enter.
Huh, that's good. A potent analogy for recognizing when you have reached your personal enough in your financial life.
And resisting the persistent urge to chase ever-increasing numbers, irrespective of the escalating risks involved.
And Rajat Gupta's reflections after his imprisonment, his regret over being so attached to his professional reputation and accomplishments,
Yeah, that was powerful.
really drives home the critical point that certain things, like your integrity and personal freedom, are simply never worth risking, regardless of the potential financial rewards.
It powerfully underscores the fundamental importance of defining your own personal threshold of enough and prioritizing those aspects of life that truly matter beyond just accumulating wealth.
Absolutely.
All right, now let's shift our focus to something truly remarkable in the world of finance: the potent combination of time and compounding.
Ah, the magic of compounding.
It's a concept that can often feel abstract or theoretical, but its practical impact over the long run is nothing short of extraordinary.
The book uses a fascinating example from science to illustrate this fundamental principle, Milutin Milankovitch's theory of ice ages.
Ice ages, how does that connect?
Well, he discovered that seemingly minor, consistent shifts in the Earth's orbital patterns, occurring over vast timescales, tens of thousands of years, can lead to enormous long-term effects, like the formation of massive continental ice sheets. It's a powerful demonstration of the cumulative effect of small, consistent forces acting over extended periods.
And this, the book argues, is directly analogous to Warren Buffett's remarkable wealth accumulation.
Exactly. While he is undoubtedly an exceptionally skilled investor, the real key to his extraordinary success isn't solely attributable to consistently high returns.
It's the time.
It's the fact that he has been a consistently successful investor for over 3/4 of a century.
The sheer numbers are quite staggering.
The vast majority of his considerable net worth was actually accumulated after he reached the age of 50,
After 50, wow.
and an even greater portion after he became eligible for Social Security in his mid-60s. This powerfully highlights the crucial role of decades of consistent investment, rather than just achieving exceptionally high returns in any given year.
The book uses a really effective thought experiment to truly illustrate this point.
Yeah, what if he'd started later?
Exactly. Even if Buffett had achieved the same impressive annual returns, but had started investing later in life and retired at a more conventional age, say 60,
Right.
the difference in his accumulated wealth would be almost incomprehensibly vast. He would still be very wealthy, sure, but nowhere near the legendary financial figure he is today.
It's because our brains tend to operate linearly, don't they? We intuitively grasp addition much more readily than multiplication,
So the exponential growth generated by compounding.
where investment returns themselves generate further returns over time. It's often counterintuitive to our natural way of thinking.
The book uses a simple example, like repeatedly adding 8 versus repeatedly multiplying by 8.
To vividly demonstrate how quickly exponential growth surpasses linear growth,
Hmm.
and the example of data storage capacity moving from megabytes to terabytes in just a few decades
Yeah, that's a good one.
further underscores how we consistently underestimate the sheer power of compounding when it's allowed to operate over extended periods.
It serves as a fundamental reminder that patience and adopting a truly long-term perspective are absolutely essential for effectively harnessing the transformative power of compounding in our own financial lives.
Patience is key.
So we understand the potential for wealth accumulation through compounding, but the book then makes a crucial and often overlooked distinction.
Which is,
Getting wealthy and staying wealthy are fundamentally different sets of skills.
yes, very different. This distinction is sharply illustrated through the contrasting experiences of figures like Jesse Livermore.
The famous trader from the 29 crash.
That's him. Made a fortune, but subsequently lost it all and tragically took his own life.
And Abraham Jermansky.
A real estate developer who also experienced bankruptcy after making highly leveraged bets on the market. Both individuals demonstrated an aptitude for accumulating wealth,
Yearly.
but ultimately failed at the critical skill of preserving it.
The book argues that the key to achieving lasting, long-term financial success isn't solely about maximizing potential gains. It's fundamentally about survival.
Survival. You absolutely must be able to weather the inevitable economic downturns and unexpected setbacks to allow the consistent power of compounding to continue its work over long haul.
The statistical evidence here is quite sobering, isn't it?
It is. The book points out the high rate of turnover within the Forbes 400 list.
Right. People drop off.
And the fact that a significant percentage, like 40% of publicly traded companies, eventually experience a substantial loss in their value. Maintaining financial success is an ongoing and often precarious endeavor.
Michael Moritz of Sequoia Capital offers a really insightful perspective on this.
The venture capital firm.
Yeah. He attributes their firm's remarkable longevity not just to making brilliant investment decisions, but also to a constant underlying fear of going out of business and a deliberate avoidance of complacency.
Wow, a constant fear. That survival mindset is absolutely crucial because the benefits of compounding require time to fully materialize.
You simply cannot achieve those extraordinary long-term results if you are constantly being forced out of the game by taking on excessive risks or failing to manage downturns.
Right. The book emphasizes what Warren Buffett has consistently avoided doing throughout his long career.
What he didn't do.
Exactly. He hasn't gone bankrupt, he hasn't suffered irreparable reputational damage, and he hasn't been forced to exit the investing arena prematurely. These avoidance factors have been just as critical to his extraordinary success as his investment acumen itself.
Nassim Taleb's succinct quote perfectly encapsulates this crucial distinction.
Which one?
Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
Powerful. Avoid ruin at all costs.
Okay, so how do we cultivate this essential survival mindset in our own financial lives? The book delves into this.
Yeah, it emphasizes prioritizing financial resilience, the ability to withstand setbacks over the singular pursuit of the absolute highest returns.
The core of the survival mindset lies in understanding that achieving robust long-term returns is far more likely if you can simply remain in the game.
Which often necessitates adopting a more conservative financial approach, even if it might feel counterintuitive during periods of rapid market growth.
Holding on to cash during a booming bull market can certainly feel like you're missing out, right?
Definitely. But the book argues that having that financial buffer allows you to effectively weather inevitable downturns and avoid being forced to liquidate assets at deeply unfavorable times.
It's about prioritizing long-term stability, even if it means potentially experiencing some short-term underperformance relative to more aggressive strategies.
A well-designed financial plan, therefore, proactively accounts for the inherent uncertainty of the future. It incorporates a significant degree of room for error.
Room for error, that sounds crucial.
It is, recognizing that our initial assumptions and forecasts will inevitably be imperfect. The more your financial plan relies on specific, optimistic scenarios unfolding perfectly.
The more fragile and susceptible it becomes to unexpected events.
Exactly. The book provides a stark but important reminder of just how inherently unpredictable the world is.
Wars, pandemics, recessions.
Major economic recessions, devastating natural disasters,
Mhm.
things largely unforeseen by most at the time.
And what might be surprising to some is that even amidst all this inherent uncertainty, an investor doesn't actually need to be right all the time to achieve substantial financial success.
No, that's a key point. The book astutely points out that you can be wrong on your investment decisions a significant portion of the time, even as much as half,
Half the time.
and still build considerable wealth due to the disproportionate impact of a few highly positive tail events,
Yeah.
those rare but exceptionally impactful successes.
Like the Walt Disney example. His first studio went bankrupt. Most early cartoons lost money.
Right. Yet the few that achieved significant success ultimately laid the foundation for the vast entertainment empire we know today.
It clearly demonstrates that even major, transformative successes are often built upon a base of numerous smaller failures and setbacks.
This fundamentally highlights why we shouldn't become overly discouraged by individual investment setbacks or periods of underperformance. Truly huge successes are often statistical outliers.
And we tend to focus on those outliers, right?
We do. And our natural tendency to focus on these exceptional cases can inadvertently make our own normal rate of failures feel more significant and discouraging than they actually are in the broader context of long-term financial progress.
George Soros had a great quote about this.
Oh, yeah?
It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong.
Managing the magnitude. That's a really powerful and important perspective shift. It emphasizes the critical importance of effectively managing the size of both your wins and your losses, rather than solely striving for perfect prediction.
Which is pretty much impossible anyway.
Right.
Okay, now let's turn our attention to something that is often significantly undervalued when we consider the role of money in our lives. The truly priceless value of having control over our own time.
No, this is a big one. Research conducted by Angus Campbell on happiness revealed a somewhat surprising finding.
Who was that?
Higher income levels do not automatically translate into greater levels of happiness.
Interesting.
And the book shares a compelling personal story of the musician Derek Sivers.
Right. He found true financial freedom and genuine happiness, not when he sold his company.
But rather when he reached a more modest level of savings that afforded him significant control over how he spent his time each day. Control over time.
It's quite paradoxical, isn't it? The United States, despite being the wealthiest nation in recorded history,
Yeah.
consistently reports higher levels of worry and stress among its citizens compared to the global average.
The book suggests this apparent disconnect might be attributed to the fact that increased material wealth has often come at the significant cost of reduced personal control over our time. Well, the fundamental nature of work has shifted, more towards intellectually demanding and decision-making roles,
Right. Thinking jobs.
often blurring the traditional boundaries between professional responsibilities and personal time. It feels like work never truly ends.
The book uses the example of John D. Rockefeller's approach, dedicating significant time to strategic thinking.
Right, an early illustration of this dynamic. Our brains are now often engaged in work-related tasks long after traditional working hours, further eroding the sense of having true control over our personal time.
This gradual erosion of control over our own time is a significant factor impacting our overall well-being and sense of fulfillment.
Definitely. Research involving interviews with the elderly, highlighted in Carl Pilmer's work, frequently reveals that regrets often center on how they chose to spend their time.
Not usually about not having enough money, but about time.
Exactly. This really reframes our understanding of the true value of financial independence. It's not solely about accumulating a specific monetary amount.
It's about freedom.
It's fundamentally about gaining the ability to control your own time and the options available to you. That, the book convincingly argues, is an exceptionally valuable and often overlooked currency.
It serves as a crucial reminder for us to carefully consider how our financial decisions impact our most precious resource, our time.
And to actively prioritize opportunities that enhance our personal autonomy and control over our daily lives.
Absolutely. Now, let's explore a fascinating and perhaps somewhat counterintuitive point: the often hidden nature of true wealth.
Ah, the difference between rich and wealthy.
Exactly. We often mistakenly equate being rich with outward displays of high spending, but the book makes a critical distinction.
Right. Being rich is often characterized by a high current income and readily visible conspicuous consumption. The expensive cars, the large houses, the designer
The
goods.
flashy stuff.
Yeah. But being wealthy, according to the book's definition, is fundamentally about accumulated assets, income that is consciously not spent,
Right, the savings.
and the resulting financial flexibility and range of options that come with this accumulated wealth.
The book uses a simple but illustrative anecdote about valets and drivers of expensive Porsche
Oh,
vehicles.
yeah.
We might instinctively assume someone driving a high-end sports car is wealthy, but they could just as easily be someone with a relatively high income who is allocating a very large portion of it to that one highly visible asset.
Potentially leaving them with little true underlying wealth. Just because you see it doesn't mean it's real wealth.
The example of Rihanna, reportedly facing near bankruptcy despite earning millions, illustrates this perfectly.
Right. There's a significant gap between simply wanting to spend $1 million and actually being a millionaire.
Which requires consistent financial discipline, restraint, and a commitment to saving.
The key insight here is that true wealth is often invisible.
Invisible.
Yeah. It's represented by the unsold assets, the unspent income, the financial reserves that aren't on public display. Because we can't readily see it, it becomes much harder to identify and learn from truly wealthy individuals while they're alive.
Like Ronald Reed again, his immense wealth remained completely hidden.
Exactly. This inherent invisibility also means that we tend to focus on the wrong indicators when assessing financial success.
Like income or spending.
Right. The book emphasizes that building true wealth has far more to do with your consistent savings rate and your commitment to frugality than solely with investment returns or income size. It's ultimately about the gap you create between what you earn and what you consciously choose not to spend.
That gap is everything, which leads us very nicely into a discussion about the power of efficiency and the wisdom of aiming to be reasonable rather than strictly rational in our financial decisions.
Yeah, the book uses a really insightful analogy from the 1970s oil crisis.
How did we overcome that?
Well, we didn't just overcome the shortage by discovering vast new oil reserves. We also became substantially more energy efficient in our consumption.
Ah, efficiency.
Right. The U.S. today uses significantly less energy per dollar of GDP produced than in 1950, and vehicle fuel efficiency has more than doubled since 1975.
Applying this to personal finance, the book argues that increasing our savings rate, becoming more financially efficient, is often more directly within our control.
And can have a more profound impact on our long-term financial well-being than solely focusing on the often elusive pursuit of higher investment returns.
Learning to find contentment and happiness with less consumption creates a larger, sustainable gap between what you have and what you desire.
Which achieves a similar outcome to increasing your income, but is often more directly within your personal control. And these consistent savings provide a valuable but often hidden return, flexibility, and options.
The book then makes a really important point about the limits of striving for cold, purely logical rationality in finance.
Yeah, instead it wisely advocates for aiming to be pretty reasonable.
Pretty reasonable. Not perfectly rational.
Right. The reasoning is that adopting a reasonably sound approach is often more realistic, sustainable, and easier to adhere to consistently over the long term. And consistency is what drives success.
The book illustrates this with the fascinating historical example of Julius Wagner Jauregg,
who treated syphilis by infecting patients with malaria to induce a fever.
Whoa!
Yeah. It highlights the distinction between what might be strictly rational, fever can combat infection, and what is actually reasonable. Patients, understandably, don't want to feel acutely ill from malaria.
It powerfully highlights that even if a particular financial strategy appears mathematically optimal on paper,
if it consistently causes you significant anxiety, stress, or discomfort, you are far less likely to stick with it over the long term. Our financial strategies need to help us sleep soundly at night.
So that explains why seemingly irrational financial behaviors,
like a slight home bias in investments, enjoying picking a few individual stocks, or even John Bogle investing in his son's funds for family reasons,
can be perfectly reasonable if they contribute to your overall comfort level and help you remain engaged and committed to your broader financial plan. Reasonable beats rational if rational keeps you up at night.
Exactly.
All right, we're nearing the end of our deep dive, but there are a couple more absolutely crucial concepts. One is the vital necessity of expecting the unexpected.
Oh, definitely. As Stanford professor Scott Sagan wisely put it, things that have never happened before happen all the time.
A great quote.
The book underscores that while studying history provides valuable insights, it's fundamentally limited as a perfect predictor of future events, especially in complex systems like investing, influenced by unpredictable human behavior.
Unlike hard sciences like geology or medicine, investing involves countless individuals making imperfect decisions based on incomplete information.
Which frequently leads to surprising and unpredictable outcomes. The book reminds us that major economic turning points and market events are often triggered by unforeseen surprises.
Nassim Taleb's example of the Fukushima nuclear plant is perfect here.
Right. Engineered to withstand historical earthquakes, but failed due to an unprecedented tsunami. It illustrates this inherent failure of imagination.
We anchor expectations on the past without considering truly novel possibilities.
And Daniel Kahneman's crucial insight here is that the fundamental lesson from surprises isn't just that we made a specific forecasting error, but rather that the world itself is inherently surprising and often defies our neat models and predictions.
This is precisely why relying too heavily on long-term historical averages or established patterns can often be misleading.
Right. Significant structural changes, like the recent adoption of 401ks and Roth IRAs, mean the fundamental rules are constantly being rewritten.
The book also touches on the evolving frequency and magnitude of recessions.
And how even foundational investing books like Graham's The Intelligent Investor, while containing timeless wisdom, may not function as precise how-to guides today.
The markets, technology, competition, it's all different.
The key takeaway is to approach the future with intellectual humility, recognizing the limits of prediction, and realizing that more recent history is often a more relevant guide than very distant history.
Because it's more likely to reflect current conditions.
Exactly.
And this naturally leads us to the final core idea, the crucial importance of planning with humility and intentionally building in that essential room for error.
Yes, revisiting this foundational concept. The book uses the example of skilled blackjack card counters.
How so?
Even when the statistical odds are demonstrably in your favor, it is never prudent to bet everything on a single hand. There's always a chance of being wrong.
And you need sufficient reserves to withstand losing streaks and stay in the game.
The central principle is clear. There is never a moment when you're so absolutely certain that you're right that you can justifiably bet every single chip in front of you.
True wisdom lies in humbly acknowledging uncertainty and deliberately creating a substantial buffer between your optimistic expectations and what could realistically happen.
The book points out how often we underestimate the need for this margin of safety, precise stock price targets, overly optimistic project timelines.
Guilty as charged sometimes.
We all are. It outlines specific areas for investors to build in error margins, tolerating volatility, financially and mentally.
Right, not panicking.
Aiming for satisfactory, sustainable outcomes rather than perfect optimization. Munger's aim low idea.
And rigorously avoiding any level of ruin risk that could knock you out of the game entirely.
Even if the theoretical odds appear favorable, like Russian roulette, bad odds even with one empty chamber.
This deliberate room for error acts as crucial protection against unimaginable events, black swans.
And mitigates the dangers of single points of failure. Like airplane redundancies, our financial plans need resilience.
And the book wisely reminds us that our own future selves, desires, priorities will likely change.
The end of history illusion. So it's prudent to avoid overly rigid or extreme financial plans we might later regret.
Successful long-term investing inevitably has a price, volatility, fear, doubt, uncertainty.
And we should view these as a necessary fee for potential long-term returns, not a punitive fine to be avoided at all costs.
The examples of Netflix and Monster beverage stocks show high returns often come with significant periods trading below previous highs.
Right. Trying to avoid that price, like GE manipulating earnings, often leads to bigger problems. Understanding volatility as a fee makes it easier to stay invested long enough to benefit.
Okay, let's touch on bubbles and short-term thinking quickly.
Learning from bubbles is hard, right?
Yeah.
No clear diagnosis, disagreement on causes.
And no one wants to believe they own an overvalued asset.
The dot-com bubble. Seemingly crazy valuations could be rational for short-term traders focused on momentum. Money chases returns.
High trading volumes showed a short-term focus. Similar thing in the housing bubble, mid-2000s expectation of quick flips.
The danger is when long-term investors take cues from short-term traders playing a different game, Cisco's extreme valuation in '99 is a stark example.
It's like misinterpreting someone else's spending when they're playing by different rules.
Exactly. Now, pessimism. It often sounds smarter, doesn't it?
Yeah, pessimistic forecasts seem more serious than optimistic ones, even though history shows long-term growth. Matt Ridley's point.
John Stuart Mill said pessimism sounds intellectual. And financial pessimism is easy, and persuasive money affects everything. Loss is vivid.
We extrapolate present trends without considering adaptations, like the oil predictions versus the fracking revolution.
Progress can be underestimated too, like the Wright brothers' early flights being ignored. Growth compounds slowly. Destruction and loss of confidence are fast, narrative-driven.
The 2007 versus 2009 U.S. economy example is powerful. Tangibly similar, but the narrative collapsed housing prices, banker prudence.
Right. The breaking of the housing narrative triggered a cascade. Economic storytelling is potent.
Which leads to, when we'll believe anything.
The story of Hazaji, the desperate father believing ineffective treatments for his son. When stakes are high and solutions uncertain, we become susceptible.
Like listening to bad investment advice or falling for Ponzi schemes like Madoff's The Power of a Compelling Story and the Desire to Believe.
Even the Fed underestimated the 2008 contraction. Predicting severe downturns is hard.
We all operate with an incomplete view, but construct a complete internal narrative to make sense of things. Like a child's understanding of dad going to work.
Kahneman's insights apply here. Planning fallacy, neglecting others' plans, overemphasizing skill, ignoring what we don't know, leads to overconfidence.
This internal narrative, necessary for functioning, can be detached from reality. Like doctors initially resisting patient consent, believing in one right way.
Contrasted with the modern approach, presenting options, empowering patient choice, recognizing different valid perspectives.
Okay, let's bring it all together. Final thoughts on better financial behavior from the book.
Less ego equals more wealth saving is the gap between ego and income. Manage money for peace of mind, tailored to you.
A long time horizon is powerful. Accept things going wrong. Focus on the overall portfolio.
Use money to gain control over time that's priceless. Be nicer, less flashy. Respect comes from humility, not stuff.
Save without needing a specific reason. Hedge against life's surprises. Define and be ready to pay the price of success. Volatility, uncertainty.
Champion room for error, for endurance and compounding. Avoid extreme financial decisions. You'll likely change over time.
Remember, people are often more risk-averse for themselves than they advise others. It's personal.
Important decisions are often made at the dinner table, driven by values, not just spreadsheets.
The host's anecdote about hitting a stable lifestyle goalpost early to facilitate high savings without feeling deprived is relatable.
And the final reminder, everyone eventually faces unexpected large expenses. Saving for the unpredictable is one of the best reasons to save, letting compounding continue uninterrupted.
So as we conclude this deep dive, it's abundantly clear that achieving lasting financial success is deeply, inextricably intertwined with our individual psychological tendencies and behaviors.
Shaped profoundly by our unique personal experiences and the narratives we construct.
By gaining a deeper understanding of these powerful psychological forces, you, our listener, are now far better equipped to gain valuable insights into managing your own financial life.
Making more informed and hopefully more reasonable decisions.
And here's a final thought-provoking question for you. Think about one financial belief you currently hold quite strongly. How might your own personal history be significantly influencing that belief?
And are there perhaps different life experiences?
Something to reflect on. We strongly encourage you to further explore these fascinating ideas and consider how the psychology of money plays out in your own life.